All right, let's dive into S&P Global's third quarter earnings. This was a report that really made the market sit up and take notice, and for good reason. We're going to get straight to the heart of it.
I mean, seriously, you don't get a much more powerful opening line than that. The CEO, Martina Chung, came right out of the gate and basically said this was the best we've ever done. And you know what? The numbers that followed, absolutely 100% backed her up.
So, the big story here is what we on the street call a classic beat and race. They didn't just squeak by expectations, they blew past them, and then told everyone the rest of the year is going to look even better. Let's break down the numbers that got everybody so excited.
First up, the bottom line. Just wow. Adjusted earnings per share hit $4.73. That's a huge 22% jump from last year, and it absolutely smashed what analysts were expecting by almost 50 cents. This wasn't a close call. This was a knockout.
And it was the same story on the top line. Revenue came in just shy of $3.9 billion, up 9%. But what's really impressive here is that the main engines of the business were just firing on all cylinders. You've got ratings up 12%, indices up 11%. This is just really strong, broad-based momentum.
So, the big question, right? How did Wall Street take all this record-breaking news? Well, pretty much exactly how you'd think. The stock jumped right away and finished the day up almost 4%. And it did that on way heavier trading volume than usual. This was a quarter that investors definitely noticed, and they rewarded it.
Okay, so headline numbers are great, but let's pop the hood and see what's really driving this thing. Because the real story of just how well this company is run, well, that's in the margins and in how they're using their cash.
And this number says it all. They grew their adjusted operating margins by 330 basis points. I mean, that's a massive 3.3 percentage point jump, pushing their margins over 52%. Management said it was all about disciplined execution and being more productive. So this isn't just a good market lifting them up. This is them getting better at what they do.
Management also gave us this really fascinating look at their defensive moat. And the key takeaway here is just huge. Over 95% of their revenue is tied to their own proprietary stuff. Their benchmarks, their exclusive data. In an age of AI, having a walled garden like that, well, that's an incredible advantage. And if you needed any more proof of their confidence, they really put their money where their mouth is. They announced they're going to buy back another $2.5 billion of their own stock just in the fourth quarter. That's a massive vote of confidence from the people who know the business best.
Now, this quarter wasn't just about the financials. It was also about some really aggressive, really smart strategic moves. They're actively trimming the fat, selling off non-core businesses, and plowing that cash back into high-growth areas.
I mean, just look at this timeline. It's a whirlwind. They closed one sale, announced two more, and then bam, they dropped $1.8 billion on a company called With Intelligence. That's a huge push into private markets data. It's clear they have a plan, and it's all leading up to their big investor day.
So you have to ask, right? What is the grand plan here? What's the end game with all this buying and selling? Well, the earnings call made it crystal clear. This is all part of a very deliberate, multi-year strategy to dominate the world of data and analytics.
And at the absolute heart of that strategy is a massive, long-term bet on AI. They've poured over $1 billion into AI since they bought Kensho way back in 2018. They didn't just jump on the bandwagon. They built the foundation first, then they moved into Gen AI, and now they're hitting the accelerator. The key here is that this bet they made years ago is really starting to pay off now.
So after a quarter like that, and with all this strategic stuff happening, what's next? Well, management gave us a pretty clear answer. They raised their guidance for the full year, basically telling us, hey, this strength isn't a fluke, it's going to continue.
And this table just lays it all out. We're not talking about little tweaks. They're boosting revenue growth expectations, raising their EPS target to a range between $17.60 and $17.85, and they now expect operating margins to break that 50% barrier. This is a big, comprehensive upgrade that just screams confidence.
All right, so it's time for the next call. We've gone through the numbers, we've gone through the strategy. So what's our final verdict, and how would we think about playing this?
Okay, so our verdict is in. We are initiating coverage with an outperform rating. The reasoning is pretty straightforward, honestly. You've got flawless execution, a super sharp strategy focused on the right growth areas, and they're throwing cash back to shareholders. All of that together signals that this momentum is real and it's sustainable.
Okay, so how do you play this? Here's the idea. The big thesis is that their investor day on November 13th could be a huge catalyst.
We think they might unveil a new multi-year plan that could get the market to value the stock even higher. So, one idea is to use long call spreads heading into the event. It lets you play for that upside but keeps your risk defined. Or if you want something a bit more market neutral, you could try a pair trade. Go long SPGI and short a competitor who isn't as diversified and doesn't have these kinds of margins or strategic focus.
This is not financial advice.